So what factors influence the Fed's current decision? How is their outlook evolving? And what does all this mean for the financial markets and for portfolios in coming weeks and months? Hi, I'm Joe Davis. Please check out this video. We'll talk about the factors, cross currents that some have been here, a weakening labor market, but one that is not completely deteriorating. At the same time, emerging cross currents. We got geopolitical tensions and the rapid rise in oil prices. So how they will unfold, and more importantly, what the Federal Reserve may do, which may affect the markets, we'll talk about in this video. The Fed's decision to hold rates steady is really emblematic of the tensions in the U.S. economy and for the financial markets. So we're clearly in wait and see mode from both the Federal Reserve as well as the economic landscape. We've had a labor market that has cooled markedly. It's been part of our baseline forecast. We were anticipating at some point even modest job losses. We've seen that recently. At the same time, we have the cross currents from high and rising oil prices, which was not originally part of our forecast, and nor the Federal Reserve's, which is going to push against, bringing inflation down. That's going to push inflation up, and so we got weaker labor market, but still robust growth. That seems unusual, and then you got the stagflationary shock. So I think what we saw from the Federal Reserve was expected to remain on hold. They anticipate only one easing this year because the labor market holds up modestly, yet you'll have a modest inflation headwind. And we have a similar expectation, which has not changed. Only modest easing, in part because inflation would remain sticky, and then we think the labor market will firm. And the biggest wild card really is the price of oil, which is by far the most important indicator. I only would get concerned if we see oil prices breach $150 a barrel and stay there for a little bit. That is not our baseline, but it's something that would lead to markedly weaker economic activity, much higher inflation, and that would put the Federal Reserve in even a trickier spot than they presently are in. So the key indicators I'm watching are twofold. One is clearly just the labor market and everything underneath it, not just the headline number. Are we adding jobs? Are we subtracting from jobs? But the unemployment rate with that, that's the balance of weaker labor supply with also is demand going to pick up, which will push up the hiring rate, which is really stalled for some time. And then the second one is always been a wild card and it rears its head every so often. That's the price of oil. It's always almost always accompanied an economic slowdown, and they tend to be rapid in nature. So our baseline is not for a continued rise in oil prices, but it's by far the risk factor. I think those two factors, where demand is from the labor market and where that price of oil could go, that could tip a balance, those will be the two key factors for, I think, the economy as well as the financial markets. And then with that, the Federal Reserve as well in the coming months. Please be sure to like this video and to subscribe to this channel to hear from Vanguard thought leaders.